WTI's price action seems to have stabilized since the start of the week and is about to correct lower. In the current report, we intend to have a look at the state of the US oil market, yet also on an international level, and discuss factors on the demand and supply sides that drive oil prices. To conclude the report, we also provide a technical analysis of WTI's daily chart. We make a start with the situation in the US oil market. It should be noted that the number of active oil rigs rose from 506 to 508 according to Baker Hughes. The release highlighted a halt in the closing of active oil rigs for the past 3 weeks in the US and tended to imply a possible rebound for the demand of oil, which may have had a bullish effect on oil prices. On the other hand, API reported an increase of US oil inventories of 3 million barrels. The release reversed practically the drawdown reported the week before and was a first signal that the production levels surpassed oil demand in the US oil market, enhancing some bearish tendencies for the commodities price. On Wednesday, the initial hunch for a slack in the US oil market was reinforced as EIA also reported an increase of oil inventories. Overall, should there be additional signals for the slack in the US oil market widening, we may see oil bears grabbing the opportunity and driving oil prices lower. The release of the US CPI rates for March took the markets by surprise yesterday as the rates accelerated both on a core and a headline level. The release may add more pressure on the Fed to keep rates high for longer in order to curb inflationary pressures in the US economy. Should tight conditions in the US financial environment be maintained for longer, we may see oil demand being driven lower as economic activity could ease in the US economy and especially the oil-thirsty manufacturing sector. Furthermore, the release understandably provided support for the dollar against its counterparts, and the elevation of the dollar could have as a side effect more expensive oil purchases for users outside the US, thus weighing on its demand on an international level. Tensions in the Middle East remained high in the past week, and the scenario of a possible strike of Iran on Israel is still present. Actually, the possibility for such a scenario to materialize seems to rise, and as long as the market worries about the issue intensify, we may see oil prices getting fresh support. In the latest update, US intelligence agencies expect an intensification of attacks from Iran on Israel. A possible strike could take the form through proxies like Houthi rebels in Yemen, but also as a direct hit from Iran on Israel, either by drones or by missiles. The latter scenario tends to pose the greater threat of the two for instability in the international financial markets and may create mayhem to the oil market, with the commodity getting possibly asymmetric support. On the production side of the international oil market, we highlight the release of OPEC's report later on today. We expect the report to highlight the low production levels planned by OPEC Plus members, while at the same time we would not be surprised to see the oil-producing organization providing a forecast for a healthy demand for the commodity on a global level. Overall, we may see OPEC's report having a bullish effect on oil prices. The rise of WTI's price seems to have temporarily halted, and the price action seems to be revolving around the 85.55 resistance line since the start of the week. We note that the current stabilization of WTI's price action occurred once it hit the upper boundary of the upwards channel guiding WTI since the 5th of February. Despite the relative stabilization of the price action over the past few days, we tend to remain bullish for the commodities price. Should the bulls actually maintain the initiative, we may see WTI's price breaking clearly the 85.55 resistance line, turning it into a support line, and take aim of the 89.60 resistance level. Should the bears take over, we may see WTI's price breaking initially the lower boundary of the upwards channel, signaling the interruption of the upwards movement, and continue lower to break the 80.20 support line. Should the S1 be broken, we note the 76.50 support base as the next possible target for the bears. Those were the top financial stories for this hour. From all of us here at IronFX, we wish you solid trading.